So this is typically a way for participants in these plans to get free money and really kind of help to grow their retirement savings through their employer plans. Hi, my name is George Sardakis. I am an associate at Vincent Hirsch Financial Services. We are a family-owned and operated financial services firm. We've been in practice for just about 8 decades. And today we're going to go over retirement planning and advanced strategies. And we're going to go through some more complex topics and maybe some things that we may have heard of, maybe some not. As always, if anyone has any questions, we're always open to calls. We're always open to comments, questions, concerns, etc. So let's dive right in. Today we're going to go over retirement plan basics, kind of a 101 surface level topics. We're going to go over advanced planning techniques, which we'll obviously get into a little later. And then finally, we're going to go over income in retirement and kind of some distribution strategies that we put together when considering retirement planning. So first and foremost, we're going to go over retirement accounts. And we have a bunch of different types. We're going to start with employer-sponsored plans. We're going to start by talking about our 401ks, our 403bs, 457s. 401k, 403b are typically those employer-sponsored plans that may offer a match. 401ks are the private version of 403bs, and what I mean by that is if we work for a for-profit corporation or employer, think of something in the tech sector or pharmaceuticals, for example. These are typically for-profit corporations. They will offer a 401k. Those are typically more common than a 403b, which are offered by not-for-profits. So think of schools, hospitals. Sometimes we'll see them in municipalities, etc. 457s are typically state and governmental, or for state and governmental employees, such as police officers, firefighters, maybe people who work in the courthouses, things or employees like that. Characteristic of employer-sponsored plans are the match. So typically how this works is you may have your employer offer a 5% match. But what does that mean? That means that for every dollar we contribute, our employer will match that up to 5% of our salary. So if we contribute 10% of our salary, then our employer will match 5% in this example. If we contribute 3%, our employer is only going to match 3%. So this is typically a way for participants in these plans to get free money and really kind of help to grow their retirement savings through their employer plans. And then finally, and we'll get to this in a couple of slides, we have our annual contribution limits, which are defined for 2025. The 2026 numbers I don't believe have come out yet, and catch-up limits for those participants who are over 50 years of age. On the other hand, we have our individual retirement accounts, or our IRAs. We have 2 types, and those are traditional IRAs, which go in pre-tax, and they continue to grow tax deferred, but when we go to withdraw them, they're taxed as income, assuming that we withdraw the funds after age 59 and a half. If we withdraw the funds before age 59 and a half, we're going to incur a 10% penalty. There are no income limits when it comes to the contributions of traditional IRAs. We can make as much money or as little money as we are, and there's no penalty imposed. Whereas on the Roth side, that money goes in post-tax. So we're not able to get the tax deduction for it in the year that we contribute, but provided that the funds are in the account for 5 years and we withdraw the funds after age 59 and a half, we are able to take the funds out tax-free. And that's huge. And that's been a huge consideration for any financial planner or financial advisor when they're doing retirement planning, especially when we try to consider taxes in retirement if we have a pension, a Social Security, or any other kind of taxable bucket. Roth IRA contributions, to make a direct contribution to Roth IRA, you're subject to an annual limit. And for 2025, that limit is $150,000 for those who file single, or $236,000 for those who file jointly, and that's for modified adjusted gross income. On this slide, we have the contribution comparisons for 2025. For IRAs, that's $7,000 with a $1,000 catch-up. For 401ks and 403bs, that's $23,500 with a $7,500 catch-up for those who are between the ages of 55 and 59. And that catch-up contribution grows after age 60, with a total employer and employee contribution limit of $70,000. The third type of account that we didn't really touch on are our HSAs, or health savings accounts. And those are accounts that earmark funds specifically for qualified health expenses. What happens is with these, the funds go in pre-tax, and given that we use the funds for a qualified health expense, they're actually used tax-free. So the contribution limits for this are $4,300 a year for an individual for 2025, or if it's a family contribution, it's $8,550. And then again, we have a $1,000 catch-up contribution for those who are 55 or above. Some key concepts that we note when it comes to retirement accounts are the ideas of pre-tax and after-tax, which essentially means that if we make a contribution in a year and the contribution is made pre-tax, then we're able to make the tax deduction for it in the year in which the funds are contributed. Versus after-tax, we don't get the tax benefit for it now, because the idea is that we're getting that benefit later. Vesting schedules for employer-sponsored plans essentially define when we're entitled to the funds. So as an example, if we work for an employer and they impose a 2-year vesting schedule on their match, what essentially that means is that you have to fit the criteria, whatever that may be, whether it's working for the employer or being enrolled in the plan for 2 years. That's when we essentially get the money that was matched by our employer. So if I leave a job and I leave the job before the funds vest, then I'm not entitled to that when I leave if I chose to roll it out. Versus if I leave a position, leave a job after the vesting schedule, after the vesting period, then I would be entitled to roll the funds out because I've met that criteria. When we talk about portability for employer-sponsored plans, essentially what that means is that when we change jobs, we can either roll those funds into the new plan or into our IRA, or, and this is typically the last case scenario, just due to the tax implications, we may cash out the funds and assume that. What happens in that regard is we may impose whatever premature penalty is imposed, if that were applicable, and also any tax implications that may be imposed, which which may affect our taxable gross income for that year. Next, we're going to talk about advanced planning techniques and some cool strategies that can be considered when discussing retirement planning. First of which is going to be our backdoor Roth, which is a non-deductible traditional IRA contribution. So what happens is we make the contribution into a traditional IRA, and then we take those funds and then we convert it to a Roth IRA. This is typically done if an individual makes too much money to directly contribute to a Roth IRA and can still make a contribution to a traditional IRA. So we make the contribution to traditional, and then we convert it to Roth, essentially building up that Roth bucket. When we discuss a mega backdoor Roth, it's essentially the same concept, except it's using after-tax 401k dollars to make an in-plan Roth contribution. Now, we have to be careful when we consider this because every plan is constructed differently. So we need to inquire with our plan administrator at the employer level to see if our plan allows for this. Finally, this is something that a lot of people are familiar with the concept or the term, but may not understand the concept, is that of a Roth conversion. With a Roth conversion, we take money that's already in traditional assets, whether it's a 401k or a traditional IRA, and we withdraw the money from there and then we convert it to Roth. Now, there is a taxable event that occurs there, and we may incur a penalty depending on the age that it's done. But you're essentially paying the taxes upon the conversion, and you're taking it from traditional and you're going to be putting into Roth, where it's assumed to grow, continue to grow, and you'll be able to assume the funds post-tax or tax-free. Now, we have to be very careful with each of these strategies when it comes to the tax considerations. So when working with an advisor or working with a planner, make sure to consult your CPA or a qualified accountant in order to understand what the tax implications may be for each of these strategies. Speaking of taxes, there have been some updates to tax legislation as per Secure 2.0 a couple of years ago. We have an increase in the RMD age, which is now age 73, and is scheduled to rise to age 75 by 2033. We also have Roth catch-up contributions for higher earners, and those catch-up contributions are going to start in 2026 as the IRS has finalized those rules in the transition. We also have new limits on HSA contributions, which is, as we defined before, $4,300 and for an individual and $8,550 for any familial contributions. And qualified medical withdrawals are considered tax-free now or later. With regards to employer stocks and equity compensation, whether it's an ESPP, an NSO, or an ISO, we were able to coordinate deferral and diversification for tax timing. And that's a consideration we take when it comes to retirement planning, because we want to make sure that we don't fall outside of our tax bracket and or affect any Medicare that we may be assuming, provided that we are working past age 65. And finally, there are additional self-employed retirement options that we consider, such as SEP IRAs or solo 401ks that can be implemented with a retirement plan strategy, just to continue to maximize the amount that we are able to contribute and save for retirement. Now, we turn to the income side of things. So we've already talked about the saving side of things. Now we're going to take a look at the retirement income portion. So we first address bucket theory or bucketing, which is what money are we going to need allocated for the short term, so within the next year. What are we going to need within the next 2 to 7 years, and that would be our midterm bucket, so we can be a little more aggressive with that in terms of growth, but we still want to make sure that we are taking some consideration in terms of stability or fixed income. And then finally, any long-term funds that we need outside of that time range, we continue to grow in a more aggressive fashion, just because it's going to be a little bit until we need those funds. When it comes to tax considerations in retirement, there are taxable buckets, such as our pre-tax qualified, our traditional money, which is taxed as income when we take it in retirement. We have Roth buckets, which, as we defined before, is after taxes or after tax contribution and a tax-free withdrawal. So really focusing on that tax-free element in retirement. And then after tax, which is essentially same idea as Roth when you make the contribution post-tax, but instead of growing tax-free, it will assume capital gains tax, which is at a lesser rate than income upon withdrawal. And when we look at retirement income and retirement distribution strategies, we try to make sure that we consider all three of these angles and really make sure that we are as tax efficient as possible, just because there are considerations in retirement such as Medicare. Finally, we discuss required minimum distributions, which, as before, they will start at age 73, and the first RMD is always taken by April 1st of the year after reaching age 73. So if I turn age 73 in 2025, even though I don't look it, my first RMD would need to be assumed by April 1 of 2026. And then it's December 31 each year thereafter. Roth accounts aren't imposed a required minimum distribution. So if we have Roth bucket, we don't necessarily need to worry about required minimum distribution. That's just on any pre-tax traditional funds, traditional accounts that we have. And when we look at retirement income planning and strategy, there are a couple of different buckets that we consider, such as Social Security, pensions, annuities. Those are our guaranteed elements. Those are funds that are guaranteed in retirement. You're guaranteed Social Security. If you're lucky and fortunate enough to have a pension, that's guaranteed income. And then annuities are insurance contracts which extend an opportunity for guaranteed income based on how much money has been put into the contract. We also consider withdrawals from various accounts. We spoke about the traditional accounts, right? Those are our income tax withdrawal accounts. We have Roth accounts, which again are tax-free. And then we also have our after-tax capital gains buckets, which again are cap gains. So we try to consider all of these four elements thus far in concert with one another just to make sure that we manage our taxes appropriately. And then finally, there are some clients that, or some people just in general in retirement who either get bored or they just feel like they need to supplement their income, so they take on part-time employment. Now, there is a consideration with regards to how many hours they can work and how much they're able to earn without affecting Social Security before full retirement age. And again, these are things that we consider when doing planning. So just to wrap up, we did go over a bunch of different things, such as our retirement accounts. We went over different sources of retirement income, and then we also went over the tax implications that are associated with these different mechanisms in retirement. I do want to take a moment to thank you all for watching. Retirement planning is something that doesn't necessarily start at retirement. It starts in the years preceding. So if there are any questions, if anyone has any comments, please don't hesitate to reach out. Please feel free to contact us. And I look forward to doing another webinar and also from hearing from everybody. Thank you so much.